That's why we do this 200-day moving average. That protects you against a lot of that, right? Or at least historically has protected against something like that. Again, not financial advice here. But if we own TQQQ, we can make a lot of money on the way up. And then if we hit below the 200-day moving average, we exit so that we prevent big losses with that. And then on top of that, now we're going to own this put spread that could potentially even make us money on the way down, which I think is pretty damn interesting. Okay. Let's take a look at what the research came up with here. It did a lot of research for us. Okay. There isn't a single best put spread that dominates over 10 to 30 years, but the research does give us some pretty clear guidance on maturity, delta, and how often to roll. Okay. What the research says versus vibes. Studies on options, overlay, and tail hedging. A big 2020 Monash paper looked at a huge grid. Okay. Key findings that matter to you when buying puts outright for downside protection, longer maturities, over 6 months, up to a year, had better risk adjusted performance than short dated stuff. Really interesting. Okay, so we probably want to have longer dated puts. That actually kind of makes it a little bit easier because we don't have to trade so often. I actually like that idea. Best results were at the money or slightly out of the money puts, 85 to 100% of spot, so 0 to 15% out of the money. When they tried to cheapen the hedge using put spreads or put ratios, those underperformed simply buying the put on their main. Okay, so it actually says that they just bought puts